Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us at the MarketSite studio, we have Tom Bruni, senior writer at StockTwits, the original social platform for investors and traders across all asset classes, including stocks, crypto, and other emerging investments. Tom joins me to discuss the sector and stock themes investors are discussing in 2023. Tom, it's great to see you as always. Welcome back to Trade
Thanks
Talks.
for having me back.
Macro picture, it's still on top of everyone's mind here, right? Even though we're in the middle of earnings season, what kind of data are they looking at now?
Yeah, it's hard to get away from, but retail is kind of, well, retail professional investors, the Fed, they've shifted their focus away from the inflation data and more towards employment data. And that's because in the back half of last year, we started to see goods inflation really start to cool off. But now the real problem is that sticky component of services inflation, which makes up 2/3 of the inflation measure. So everyone is looking for signs that the labor market's beginning to cool so that wage pressure will start to decline. And if the Fed gets that, that means demand will decline as well because wages are lower, and ultimately that wage component of inflation will start to cool down and make the Fed's job a little easier.
So it's interesting the way that the market started off this year. Certainly we got that rebound. It was nice to see a little bit of green for a duration, at least a couple of weeks on the screens. But the way that it started out, I thought was really interesting in terms of what was really, moving in terms of tickers. I mean, is that the January effect or anything, fundamentals really changed?
Yeah, it's a good point because a lot of the things that we're seeing lead right now were the worst performers last year. So on one end of the spectrum, you have things like Party City and Carvana and Bed Bath & Beyond, really struggling businesses, rebounding a lot. But then on the other end of the spectrum, you have these big established tech companies like Meta that was down 60% off its highs. It's rebounded 20, 30, 40% off its lows recently. And part of that goes back to the discussion around what the Fed is going to do. If the Fed is going to start to ease things off and let rates come down a bit, then that means long duration assets like these growth stocks are going to start to benefit. So,
which is so interesting because these companies that have announced bankruptcy, and then their stocks surge. I mean, it doesn't matter what the Fed is going to do. I mean, clearly there's an issue with the operating model there, if you will. International stocks, though, really in the limelight to kick off the year. I've had more strategists on saying that emerging markets and international look really attractive.
Yeah, I think it's an interesting point because over the last decade or so, every time we get a sustained pullback in the US dollar, we start to see this outperformance from international stocks. But I think what makes this time a little bit different is the last 2 years, we've seen really global markets trade together because the economies, the markets were dealing with a lot of the same issues related to COVID. But over the last 6 months or so, you're starting to see some dispersion in their performance, which allows investors to start to pick which areas of the market, which countries specifically might benefit from some of the themes we're seeing. So for some of the specifics in China, we're seeing the reopening trade. We're starting to see, the government start to crack down less on technology stocks. Within Japan, we're seeing inflation emerge for the first time in, decades, and their central banks struggling to keep rates where they want them. India and other emerging markets like Vietnam and Indonesia are benefiting from companies diversifying their supply chains away from China and other, hard-hit areas from COVID. So there's a lot of individual themes that investors are able to play, and it's not so much just a kind of one-size-fits-all approach where you just buy emerging markets and or U.S. stocks and they kind of trade the same or in tandem. You're getting that dispersion of performance that allows individual investors to really look at the key themes and try to identify opportunities.
Right, and investors are always looking for new tools to gain an edge when they trade, and it's really amazing to me just how the impact that social media has had with that. It was a longer-term trend. I mean, it's a tool that's here to stay. Who would have thought, 10, 12 years ago?
Yeah, exactly. And I think what we're seeing now, over the last few years, it's undeniable based on the meme stock saga and just people being at home and more retail traders getting involved. Social media and online engagement around financial markets is here to stay. And we're starting to see more companies investing in content, investing in different ways to really engage who their end user is and really try to educate them and make sure they have the tools they need to find an edge in the market and stay here for the long term. And at StockTwits, we're always looking for new things to work on, new data to provide, to not just enhance the discoverability of new themes, but also give investors the tools and the data they need to do the research and get to the point where they're comfortable executing on that idea.
All right, Tom, appreciate the insight as always. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.